Joining me now is Simeon Hyman, Global Investment Strategist at ProShares, to break down where the money is flowing and what it says about the market right now. Simeon, great to have you.
Thanks for having me.
We appreciate you being at the desk, and you have an interesting perspective because you really have a front row seat to investor flows, to know how investors are feeling, where they're putting their money, and where that money's coming from. So I want to start with SpaceX because, of course, it's been the hottest trade for the past 3 days, lower today, last I checked. But when investors decide to add SpaceX to their portfolios, where is that money coming from?
There's a ton of money on the sidelines for starters. So I think that's an overlooked thing. This notion that it has to come from some other piece of a portfolio or other technology stocks, there's a lot of money on the sidelines. And I think the other thing that's missed when that question is asked is the fact that actually IPO volumes have been pretty low. We are not even at the levels of 2020 and 2021. We know there were SPACs back then, so we know there were some drivers, but there's still pent-up demand for IPOs, and of course these companies, you can't even call it incubating, they're staying private longer. So I think the look for a source is almost a little misguided. Pent-up demand for IPOs, plenty of cash on the sidelines. I almost think the question isn't really that germane.
Okay, so this is more cash than trimming some of the other AI winners. Basically, SpaceX can do well, and it doesn't have to be at the expense of other tech companies.
And interestingly, a lot of the chatter has been about the early inclusion in indices, and that's going to be important as stabilizing demand. But to keep it in context, only a small piece of SpaceX has been IPO'd. So, a couple of takeaways from that. One, anybody who's involved has the incentive for this to work for the long run because it's almost like a trial balloon. And the other piece is that its allocation in the indices will be important but not disruptive. So again, not necessarily cannibalizing anything.
What does the demand for SpaceX specifically, though, tell you about investor psychology right now? Is this fundamentals driven because it is an unprofitable company, or is this a whole lot of FOMO and potentially some froth?
Well, let's look at the market context for a second. If you go back to Q1 earnings season, S&P 500 earnings grew about 25% year over year. NASDAQ 100 earnings grew almost 50% year over year. So I like to think of this sort of as rational exuberance, as opposed to the famous Greenspan quote from about 30 odd years ago. In other words, there are fundamental drivers for the momentum of the tech names, and that's certainly extending onto the SpaceX enthusiasm. And look, there's stuff there. I mean, this is 80% of the launch business. Starlink is up and running and making a lot of money, and the call option on AI, which was to some extent sort of verified, if you will, by the Google agreement just a week or so ago, there's real stuff there.
Okay, so broadening out a bit, we keep seeing the market hit new highs, but I'm curious where you're seeing the money actually going, aside from SpaceX, because the headlines and the reality aren't always the same thing. So what are you seeing?
We do, of course, and we have a wide range of ETFs at ProShares. We're the largest provider of leverage and inverse ETFs. We also have lots of other strategies like dividend growth strategies. And so we do have a good seat to see where the money is flowing from and what investors are picking up on. Certainly the technology trade has been an important one, but there's, and momentum. Look, we have QQQA, which is our NASDAQ 100 Dorsey Wright Momentum ETF, and indeed that's been performing extremely well. But there are other opportunities for broadening that we're seeing as well. We are starting to see folks look at those dividend growth stocks and look for alternatives in case they get a little skittish about the fact that the top 10 stocks in the S&P 500 are now 40% of the index.
What's the biggest disconnect between what investors are talking about and what they're actually buying?
Oh, I don't think there is a disconnect in that regard. And in fact, the one thing that I would point out is almost a forgotten trade of late is actually allocations to small and mid-cap stocks. Very quietly, small caps have been performing really, really well this year.
Outperforming the S&P 500.
And if we think about interest rates, it's Fed day. Look, the Fed may hike.
Not today?
I don't think anything's going to happen today. But there's a little bit of pressure on rates, but it's substantially mitigated by the MOU and the bringing down of oil prices. Now the long end we suggest might still have some upward pressure because risk premium, term premium, all that stuff. But if inflation pressures come down a little bit, the short-term rates are what small caps are sensitive to, so there's an opportunity there as well.
Do you look at the strength that we've been seeing in small caps as just a short-term catch-up trade, though, or do you look at it as the beginning of something more durable or a shift in leadership?
Well, it's not exactly a short-term catch-up because the underperformance has been 15 years in the making. I think the best way to think about it is, hey, if you have a reasonably constructed asset allocation and you took a pass on small caps for the last 15 years and you won, rethink having kind of your regular allocation, maybe 10% or whatever it would be, per kind of standard allocation. Just think about that as a prudent path going forward. It may not be it may not be at the top of the charts every single week, but absolutely at half the price to book of large caps, it should have a presence in most folks' longer term asset allocation.
How big of an allocation in a
if you do the math, you're talking small caps have about a 10% slice of the equity pie, and that's what we used to call back in my early days of talking about asset allocation, the look out the window test. Mm-hmm. The starting point for good asset allocation is just how the world is laid out, and just to be more formal about it, the pro rata size of the market caps of each of those slices. So something in the 10% range makes a lot of sense.
Okay, so 10% to small cap. Break down the other 90% for us. Where should the everyday retail investor's portfolio be going?
It starts with the stock bond allocation. Mm-hmm. And here's where you almost have to hold two truths in your heart at the same time, because folks, there are two reasons to have bonds in your portfolio. One is for risk reduction and the other is for diversification. Now, risk reduction and diversification both took sort of a hit. If you go back to 2022, stocks and bonds went down together. But that was at the end of quantitative easing that artificially pushed down interest rates. And when there's 50 basis points yield on the 10-year Treasury, that price can't go up if stocks fall. Mm-hmm. Now we have 4.5%. So the diversification role is there, and the risk mitigation role is there too, particularly stay a little short duration. So there's almost an opportunity to think about a barbell approach there. On the short end of duration, one of the opportunities that we offer is interest rate hedge corporate bond ETFs. We have ticker IGHG is investment grade, HYHG is high yield. And it's a cool way, cool is a very formal technical CFA term, if
the bond market can be cool.
To get the nice spreads from corporate bonds and just mitigate the interest rate risk. And people get this a little mistaken too. Leverage, it's actually at all-time lows for the S&P 500. Maybe in the private markets we could chat, but in terms of publicly traded companies, leverage is actually quite low for large cap stocks.
Okay, so you got the bond market out of the way, the diversification there. You talked about small caps. What about the rest of the equities side of the portfolio?
Yeah,
where should that be going, given the fact that the market is near all-time highs in almost all of the major indices, and the fact that names like SpaceX will be included in the NASDAQ, but not necessarily the S&P 500.
So I think the bigger call, just like the small cap call, is the question of your exposure to international equities, which I would submit also one should think about in the current environment as maybe I should kind of have that kind of regular weight. And again, if you do the sort of look out the window test, maybe that's somewhere in the vicinity of 20% developed and another 5 or 10 in emerging markets. It's not dissimilar to the small cap story because you have valuations that are a substantial discount. Yes, you have a couple of pockets of extra interesting things. You got the chips in South Korea, but by and large, you're at a discount. And particularly if we all hope for humanitarian reasons, there's a little bit of a peace dividend, hopefully not just in the Middle East, but in the Ukraine as well. That can be a boost to both developed and emerging market stocks as well.
Okay, and then just in terms of what you think is actually going to lead this market higher from here, will it still be tech?
It's really tough to bet against momentum, but as I mentioned, the momentum piece is supported by those fundamentals. The earnings are sky high, and that's really the extended opportunity here. But look, there are ways to, think about managing that opportunity. Another ETF that we launched recently is BuyB, B-U-Y-B, ticker B-U-Y-B, and it's the S&P 500 buyback aristocrats, companies that have bought back their shares consistently. So we've got shares coming into the market through IPOs. Everybody talks about buybacks, but an important thing about buybacks is if you just see a company do a buyback once, the signal is ambiguous. With BuyB, we look at companies that have bought back their shares consistently over the years. And that offers a particularly enduring signal that the company is expecting strong growth going forward, high quality, and it can be a nice way to complement the straight up momentum driven broader market that we've been talking about.
What is the biggest risk to this market right now?
I mean, recession is still the biggest risk, and I'll call it the biggest risk, but I'll say it's not so big. The business cycle still is classically the biggest risk to the economy, and that's one of the things that we look at incessantly. And I think the risk might actually be, even though it's the biggest risk, I think it might be a little smaller than many people think, because the baseline that they're looking at to see if the economy is overheating, that's what causes a recession. Things get too hot and then they fall down. A classic measure to look at that is capacity utilization. Capacity utilization just measures in the US the amount of the productive capacity that's being used. And traditionally the measure, the tipping point is 80. If you're over 80, then you're overheating, you might have a recession. We're at 77. Now people say 77, wow, that's close to 80, we must be overheating. But now I'll tell you that the standard range historically is 75 to 85. So 77 is pretty low. The reason people think it's overheating is for the first time in COVID, it went into the 60s. But in the depths of the 70s, it stayed in the low 70s. So it's still, the business cycle is still the biggest risk, but it looks like we've had that soft landing that we talked about, a year or two ago seems to have happened.
So if the biggest risk to the market isn't that big of a risk, what does that mean about how much higher we can go from here?
Look, you can't have 20, 30% returns well into the future. We know what the equity risk premium is historically. It's somewhere between 4 and 6%. You add that to pick your point on the treasury curve, and you look at 8 to 10% over the long term. So there's nothing out there that screams that that's a outsized expectation. Remember that the earnings growth has actually brought down PE multiples. So PE multiples are actually lower than they were at the beginning of the year, even though the market's up. So that puts a little bit of context around.
So just to sum it up then, knowing that we have to scale back our expectations, and this market has already run quite a bit so far, what is the overall strategy that the everyday investor should really be thinking about right now?
Oh, it's got to be somewhere in that vicinity of your regular asset allocation, your regular weights of stocks and bonds, and then a nice mix of equities to make sure you're capturing the potential broadening into international and mid and small caps.
Do you buy any dip, or do you wait for a big pullback?
Well, look, the history of that is clear. It's tough to time the market if you're a long-term investor. So, buying the dip is a little bit of a trading activity, but staying invested for the long term is important. Should we hit up our last little bit of news on the SpaceX front before we?
Yes, we should note that there are ways to get, I guess, leveraged exposure to the SpaceX ETF through your new ETF
Sure.
at ProShares.
We're really excited at ProShares. We began trading on Monday SPCF, and that's ProShares Ultra SpaceX ETF, and that targets 2 times the daily performance of SpaceX. And it's a way to magnify a bullish view, get more exposure with less capital at risk, and you don't have to worry about margin calls. You got a single ticker in your brokerage account.
What does that tell you, though, about how strongly investors want access to the name?
Interestingly, single stock leverage ETFs are one of the largest slices of ETF launches in the last year or so. So it is a tool that investors are embracing. And the way that you can think about it perhaps is in the following manner. I mentioned that IPO volumes are not particularly high right now, and the longer times that companies are staying private, that's a little bit pent-up demand. The regular sort of organic single stock in an index demand, that's a second leg of the stool. And indeed, that opportunity in the leveraged single stock is kind of three nice legs of the stool for a very nice ecosystem, robust price discovery, and liquidity.
Okay, I think this is a great time to pivot to our rapid fire round of this or that. We're going to start with the SpaceX edition of this or that, and then we'll broaden it out. Are you ready? Quick questions,
ready.
Quick answers. SpaceX demand, new money or rotation?
New money.
Funding it, cash or AI winners?
Funding in cash?
Funding the rotation into SpaceX.
Oh, cash.
Enthusiasm, FOMO or fundamentals?
Fundamentals.
Investor behaviors, healthy or speculative?
Healthy.
SpaceX, one-off superstar or start of a broader IPO cycle?
Broader IPO cycle.
Investor mood right now, confident or nervous underneath the surface?
Confident.
Broadening it out from here. Small caps or large caps from here?
Broadening both.
No, sorry, I was broadening it out. Which has more room to run from here, small caps or large caps?
Large caps.
Growth or value?
Quality.
NASDAQ 100 or S&P 500?
Both.
US or international?
Both.
Better hedge today, gold or treasuries?
Treasuries.
Treasuries or cash?
Treasuries for a recession.
Markets by year end, higher or lower?
Higher.
How much higher?
I'm not supposed to do targets.
Single digit percentage, double digit percentage?
Something like that.
One word to describe how you're feeling about the market for the rest of 2026.
Optimistic.
We'll leave it there. Simeon Hyman, thank you so much. Really appreciate your insights.
Thanks for having me.
That's Simeon Hyman of ProShares. If you enjoyed that Street Talk, check out our full interview with Kevin Mon, where he reveals the names that he thinks is going to power the next phase of the AI revolution, and they're not the Mag 7.